Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. It is a busy show today. Mike Vinegar is our guest co-host. He is portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. He'll help us break down TD, BMO, CIBC's Q4 earnings and another bank sale. As we've been talking about banks all week, we'll also hear from Fred DiValasio, co-founder and CEO of Longhouse Capital Partners, about his firm's strategic relationships with some of Canada's biggest banks. Then Carol Label, CEO of Domini Impact Investments, will be here to tell us about sustainable investing and share some top picks in renewable energy. We, of course, want to hear from you as well this morning on First Call. You can reach us with your questions on North American large and mid-cap stocks, and we'll have Mike answer as many of them as he can. Number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes from now, and our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. TD Bank reported profit and revenue in its latest quarter that topped estimates, driven by record results in its capital markets unit. The lender's U.S. business also fared better than analysts expected. That segment remains under an asset cap as part of its anti-money laundering settlement with U.S. regulators. TD also boosted its dividend. The Bank of Montreal also beat revenue and profit consensus in its most recent quarter. BMO is also raising its dividend by 2%. The lender says better than expected performance in its U.S. division, as well as its capital markets unit, helped push results past estimates. You'll recall, in October, BMO also struck a deal to sell 138 branches in 11 states to First Citizens Bank and Trust. And then CIBC beat revenue estimates in its fourth quarter. Also saw profits surge 16% compared to the year before. Strong performances in its capital markets business helped drive results, and the Toronto-based lender also saw strength in its Canadian and U.S. commercial banking and wealth management units. The bank also decided to boost its dividend to $1.07 a share. CIBC is continuing a two-year streak of earnings beats. All right, and that essentially is our top line story. CIBC, TD Bank, BMO all beating earnings estimates in the fourth quarter. To get more details, some reaction, let's bring in our guest co-host, Mike Vinegar, portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. Mike, thanks as always for joining us.
Oh, great to be here.
Any surprises from any of this?
No. The landscape in Canada has been, the narrative has been, tariffs, slowing economy. What will that do to the banking sector? But we have to remember the banks are very conservative. And so we're not surprised by the fact that while the reserves for potential credit losses are still elevated, they're not rising as one might have believed, say, 6 months ago. They're sort of stabilizing, and you're seeing that throughout the banking sector. And the results have been pretty good, though I will note that part of the reason they've been so good is the capital markets division. So if, let's say, capital markets starts to falter a little bit or slow down, how might that affect earnings per share going forward? We'll see.
And what could be factors for that, do you think?
Just a slowdown in new IPOs, slowdown in M&A deals, concerns about the economy, slowdown in GDP growth, unemployment spike, you name it. But I mean, listen, when the markets are going up, asset management fees are going up, wealth management assets are going up, spreads are going up, trading volumes, FX currency, all of that stuff, that at the margin just adds right to the bottom line.
And you were talking about provision for credit losses. One, actually, Bank of Montreal, I think, actually lowered theirs to $755.
Yeah.
And what does that? I looked at a few others, saw them going up, and they lowered theirs for their.
Yeah. So the provision for credit losses is a very subjective kind of line in the income statement. So what the banks have to do every quarter is they have to give a reasonable projection for what they think they need to reserve. This is not a number that says this is the amount that they need to cover for actual losses. This is what they think they need to cover in order to reduce their taxable income and provide for a backstop in case what they think will occur in the future. It's already there. It's already reserved for. So we don't really pay too much attention to it, though. the direction of travel is definitely good if provisions for credit losses start to ebb down, because that will just increase capital and increase earnings per share.
And what TD did well in the U.S., even with the asset cap in place, was that surprising, or is that?
Well, so with TD, they're embarking on a few different initiatives. So one, with the asset cap in place, they've got mountains of excess capital, right? So what do they do with that excess capital? They've been buying back stock. They've been laying off employees and investing more into AI. They are on a rampage to reduce costs, both through technology and through a reduction of headcount. But, just a very well-run organization, been increasing their footprint for a long time in the U.S. So you got to believe there's some really good economies of scale, even if they can't expand their footprint for now.
Okay, and big picture, how does the market react to all this?
Well, we've
expected this.
So the old adage is buy on rumor, sell on fact. The banking stocks have done extremely well. The period of seasonal strength for the bank sector in Canada generally runs from September into the first week of December. So here we are in the first week of December. Everybody's reporting. Generally speaking, Q4 reports for the banks, which end October 31st, have in past years been very strong, because that also dovetails their year end, right? And so they all want to leave the year, let's say, on a good foot, on a strong footing. So we are not surprised. Now the question is not about what you did in 2025 fiscal, is what does 2026 fiscal look like, and what are the pitfalls, and what are the valuations? We think that the valuations are quite full. Okay. Not going to say lofty, but full compared to historical valuations for the sector.
Okay, we're going to leave it on that note. We're going to talk more about banks EQ buying. So we'll talk about that coming up after the break, and we'll take a look at the markets as well. See how things are shaping up on the markets. We'll start now with the U.S. futures first, and they're essentially flat right now, literally, pretty much. You can take a look there. Everybody's awaiting any news about a potential rate cut. It's kind of sitting and hovering right now. You can see Dow is up ever so slightly, the NASDAQ off ever so slightly, and then the S&P 500 up ever so slightly. So essentially a wash. Moving over to the Asian markets now, and they, like everywhere else, essentially sitting, waiting for that rate cut. You can see the Nikkei soaring again today, up by 2.33%. The Hang Seng by 0.75%, and the CSI 300 up by 0.34%. Moving over to Europe now, cyclicals and industrials providing some support. Defensive stocks, though, are offsetting that. And right now, though, we're still seeing all green. The FTSE up by 0.1 roughly, CAC 40, 0.5 point, and the DAX up by nearly a full point. And the TSX bouncing back yesterday and getting close to record territory again. It was up by 0.36%. Banks and tech helping that move there. And let's see who were the movers yesterday. Ivanhoe Mines up by 8.55%, 8.55. Of course, Capstone Copper up by 8.36%. And going the other way, G Mining Venture down by 4.2 roughly, and Orla Mining down by 4.1. And looking at the metals, you can see all of them are off today. They're still up near record territory, but having a down day. Some profit taking happening right now, probably 0.36% for gold. Silver futures down 1.74, and copper off by 0.86. And looking at oil, it's been a struggle for Western Canadian Select lately, but it ended up 0.62%. A lot of prices have fallen. Weakness, blaming the falling to their weakest relative to the U.S. benchmark since March. Surging production from Alberta is getting into an already well-supplied world market. That's putting some pressure. But yesterday we saw it go up. And WTI, how did it do? It's up right now, 0.75 of a point, closing in on $60 a barrel again. Okay, Canadian lender EQB is acquiring President's Choice Bank along with some related insurance businesses from Loblaw for about $800 million, with most of it to be paid in shares. The deal will give Loblaw a stake of at least 17% in EQ. And EQ Chief Executive Officer Chadwick Westlake said the transaction is meant to create a scaled challenger to Canada's big six banks. For more on that and reaction, let's bring in Mike Vineker, Portfolio Manager and Senior Wealth Advisor at Propellus Wealth Partners, IA Private Wealth. So he's trying to compete. Is there enough there to compete, do you think?
Well, you want to build economies of scale, right? Banking is about a scale business, and there's only so many clients in Canada. We're a population of 43 million, call it 20 odd million adults that are working, let's say. I'm not exactly sure how many clients PC Financial has, but I believe they have a lot of credit cards and a lot of opportunities.
Yeah, it's, I think, 3.5 million and 2 million active PC credit card users.
There you go. And so you may argue that some of those credit card users may be clients of other banks, but maybe Mr. Westlake thinks I can woo them over with some kind of new product. And banking is a cross-selling business. Once they have you in a checking account, they want to give you a credit card, they want to give you insurance, they want to give you a mortgage, whatever else. And the initial client acquisition cost may be expensive, but then the new product acquisition cost is potentially de minimis. And so that's where you see the deal with Laurentian Bank being sold and National Bank acquiring some of the branches to bolster their network. This may be a very similar thing, although EQ Bank is more of a virtual bank. And that dovetails perfectly with PC Financial, which is also more of a virtual bank, though they do have some branches within the Loblaw stores.
And do you see people getting more comfortable with that, with virtual banks?
Absolutely.
Like the opportunity, are we at that one of those points possibly where that move to virtual, nobody bats an eye?
I recall the days when ING Canada, way back when, was a competitor, offering very high rates of return on cash and opening up virtual accounts. And we're talking early 2000s. Fast forward 25 years, the next generation is very adept. We're all on our smartphones. We all want to access information online. It's CDIC insured. It is an OSFI regulated institution. So I don't think anybody has any issue. Plus, PC has built up a great reputation in partnership with Loblaws over the last 20 odd years. So this is not a brand new competitor coming into the market trying to gain confidence.
And do you see any of the other banks reacting to this?
I don't think so directly. PC has always been there as a competitor. They don't probably see it as a direct threat. Might they see it more of a direct threat with the EQB combination? Potentially. But, the big six have, call it a 15 to 18% market share each. And so they really dominate the landscape. We don't see that changing anytime soon.
Do you think EQ is setting itself up for a sale, maybe?
Oh, that's interesting. Certainly, if you bulk up and increase economies of scale and earnings per share, I do note that they had, in their recent quarter, I think they missed earnings estimates.
They did miss, I'm trying to, I know I saw the numbers somewhere. They did miss, though.
Yeah, and, this is a transition for that organization. Unfortunately, the former CEO died suddenly. And Mr. Westlake had to come in back into the organization. I guess he's trying to put his mark on the organization, and the first order of business is to bulk up the asset base, increase return on equity, increase earnings per share, and then to your point, potentially a suitor comes along and offers shareholders a really great price. I believe the stock has trailed quite a bit since its peak, and of course, compared to the other financial institutions in Canada.
Yeah, I think the quote from Westlake was, fiscal 2025 was a difficult year for EQB.
Yeah, right.
And they responded by announcing a one-time restructuring program in the fourth quarter. So, I don't know, just throwing some of those things out there. Is there anything left to buy or sell?
I'm not quite sure. Maybe Alberta Treasury branches, Van City. There's certainly some big competitors in the credit union space. Might some credit unions want to merge together to bulk up? Itchy Bank, the Indian subsidiary. I don't know if it's big enough to make a dent. The South Korean bank. I mean, there are some foreign banks of, subsidiaries of foreign banks that have gotten licenses in Canada.
Yeah.
And I wonder if at some point those organizations are going to say, you know what, we're going to repatriate our capital back.
Yeah.
We're not making a dent in the Canadian market. We have better use for the capital.
But that's about it. All right, we'll leave it on that note, Mike, but we're going to talk about what's on your radar coming up, real estate, and see why that is. That's after the break. All right, time to see what's on Mike's radar. And right now it's real estate, and we're going to go into a little bit of a psychology lesson right now on what makes real estate so interesting right now.
Well, real estate in Canada, for the most part, is probably a very big proportion of people's net worth. And we've seen a huge rise in real estate. But real estate's very cyclical. So if I take you back to the late 80s, we're seeing that right now. Yeah. So if you look at the late 80s, we had a huge drop in real estate. By some accounts, 30, 40, 50%. And while prices kind of stopped going down in the early to mid 90s, they didn't really go back up until 2004, 2005. So you had a very long cycle of, call it 15, 18, 20 years to wait to get even, right? Then from the period of 2005 to 2025, it's been a straight shot up, even through the GFC. I mean, in Canada, it was just a blip. And I remember seeing statistics that even in the most recent past, it's been about 8 or 9% of our GDP, which is a huge number.
Is that healthy or unhealthy?
Well, I think it's unhealthy by many accounts because, real estate drives a lot of jobs and a lot of industries. You think of general contracting, you think of real estate agent commission, lawyer fees, building supplies, and then everything people buy when they purchase a home, like appliances and other things like that, right? We're seeing a major slowdown. So it looks to us like the peak was in 2022 in terms of prices for residential real estate in Canada. Some markets obviously got much more overheated than others. And you're seeing the balloon sort of, I'm not going to say pop, I'm going to say the air is coming out.
While we're seeing prices drop, we're seeing sales drop. Everybody's on hold right now.
That's right. So just like the wealth effect of stock markets and people's portfolios drives potential spending and a feeling of wealth when your account goes up, it's the exact potentially same thing going in reverse when you see the value of your home going down. If your home equity is part of your retirement plan and you thought your home was worth X, and now somebody's telling you it's worth X minus 10, minus 20, minus 30, what does that happen to your psychology in spending, in helping your children, in your investing portfolio? And how does that transcend into all these different economic actors that travel around the real estate business, right?
Yeah.
So we're kind of thinking about these things right now because we're seeing the volumes drop and the prices drop in real time. We're not sure that it's affected psychology yet, but the other piece of it is the renewal Mageddon, right? So all these people that probably paid peak prices in 2020, 2021, and took out a 5-year, let's say, fixed mortgage at 0.91, 1.3, whatever those very, very low rates were, those mortgages are coming up for renewal.
Yeah.
And we are concerned about how those renewals are going to affect people's cash flows because certainly Canadians' incomes haven't kept up with inflation in many regards. And now you've got this big inflationary push from the perspective of a higher mortgage payment, right, coming home to roost. So that may affect the global psychology of the consumers, and maybe we see that in consumer discretionary spending into 2026.
So with that, because we want to talk about a couple of the stocks that are on your radar with that, are these tied into that, some of the stocks, or these are just stocks you're liking right now?
Yeah, so these stocks, I think, are not necessarily tied into that right now because the first one is, in the food business, and food's pretty recession resistant. And the second one is more related to infrastructure. And as we know, the Canadian government has just launched, hopefully will execute on a major infrastructure plan, and the same thing south of the border.
And that's with Russell Metals. That's what you're liking about
Correct.
for that. And then Premium Brands is the first one we're talking about.
Yeah, Premium Brands. Yeah. So what a phenomenal organization. I mean, they've doubled their revenue in 2019. They've proven themselves to be very adept at not only acquiring complementary businesses, but also growing organically. They now have production facilities and distribution facilities on both sides of the border. They're projected to keep growing their EBITDA at a higher than 10% clip. Their free cash flow, we think, could hit, let's say, close to $8 in the next 12 to 18 months. And the stock today, you're getting a 3% and change dividend yield with a very good growth trajectory.
All right, we're going to leave it at that on that note there, but we've got lots coming up, including Vancouver-based Longhouse Capital Partners. It's joining forces with Canadian banks, a big Canadian bank, and we'll hear from the CEO and co-founder. And of course, also coming up, first call. Our phone lines will be open soon for the first call segment. You can reach us at 1-855-326-6266, and you can email us as well, first call at bellmedia.ca. TD Bank reported profit and revenue in its latest quarter that topped estimates, driven by record results in its capital markets unit. The lender's U.S. business also fared better than analysts had expected. That segment, of course, remains under an asset cap as part of its anti-money laundering settlement with U.S. regulators. TD also boosted its dividend. And CIBC also beating revenue estimates in its fourth quarter and saw profit surge 16% compared to the year before. Strong performances in its capital markets business helped drive results, and the Toronto-based lender also saw strength in its Canadian and U.S. commercial banking and wealth management units. The bank also decided to boost its dividend to $1.07 a share. CIBC continues a 2-year streak of earnings beats. And shares of BRP are seeing a spike in pre-market trading. That's after the maker of all-terrain recreational vehicles saw a revenue surge of 15% over last year in its latest quarter. It also posted higher profit that topped expectations. The results were driven by higher off-road vehicle deliveries and new product launches. BRP also hiked its 2026 forecast for profit and revenue and will buy back up to 10% of its shares. And a quick peek at the markets right now. You can see they're in the green, but barely. Pretty much a wash right now. Everybody awaiting the Fed rate news. We'll see what happens with that. It's leaning towards a cut right now, but it's about a wash right now for U.S. futures. Well, Canada's big banks are partnering with Indigenous-owned financial firms across the country. In April of this year, Indigenous-owned asset manager and strategic advisory firm Longhouse Capital Partners joined forces with CIBC. Longhouse is raising capital to build a $1 billion fund to finance major First Nations projects in Indigenous communities like wireless towers and transmission lines. Joining us now is Fred de Blasio, co-founder and CEO at Longhouse Capital Partners. Fred, thanks very much for joining us.
Good morning.
Let's talk a little bit about the fund. What do you want to see accomplished with this, and why not work with the government on this, or will you be working with the government?
Yeah, I think we will work with everyone, quite candidly. Simplistically, Longhouse is an Indigenous-led investment platform that's built to deliver, frankly, the missing piece in Canada's infrastructure strategy, which is access to scalable, affordable capital for First Nations to participate in Indigenous equity. And we're seeing that through a blended finance approach where we take market-based capital and we marry that to all of the existing federal and provincial provincial loan guarantee programs that exist across the country. And according to some of the McKinsey research we've unleashed or were able to find, it looks like Canada's infrastructure gap is about $200 billion per annum, which is a huge number for the next decade. So you're looking at well over $1 trillion of investment opportunities. Now, contrast that with the capital available through those blended finance solutions like the Indigenous Loan Guarantee Program that the federal government has put forth, which is $10 billion. When you aggregate all of those numbers, you're getting to about $20 billion, and that's a one-time $20 billion. And if you contrast that with the $200 billion required on a per annum basis for, let's say, the next decade, you can quickly see that there's a mismatch between what is required and what is available from a loan guarantee program. So Longhouse really allows for that blended capital to take place and delivers significant amounts of capital for First Nations to take advantage of the equity call option rights that they've been afforded through UNDRIP, which was ratified back in 2021.
Okay.
Oh, that's great. Fred, I'm wondering, we always hear about a lot of infrastructure projects getting bottlenecked with permitting delays and approval delays by various levels of government. Do you believe that you're going to be able to fast track some of these projects in order to expediently be able to ameliorate some of the deficiencies within infrastructure within the First Nations communities?
So I would say that First Nations are definitely open for business. And I think when you partner upfront with First Nations, you quickly realize that not only are they loyal, but they're fairly sophisticated, and they assist in countless different ways to accelerate projects. I had the good fortune of working with a nation out west where we were able to deliver $1.4 billion to develop their lands rapidly, and that was the Sanok development here in British Columbia. And notably as well, our current Minister of Energy and Natural Resources, Tim Hodgson, when he was at Hydro One, he instituted a wholesale change in the approach Hydro One has with First Nations, which I think has served as a template for the rest of the country. And in a nutshell, what he did was he firstly took the Indigenous Relations Group out of the risk management group and put it into the business development group. So a very significant difference in terms of the approach to First Nations. And he quickly realized that if he was going to double the rate base in Ontario, he needed to become the partner of choice for First Nations. And I won't bore you with all the details, but suffice it to say that here we find ourselves with the Chatham to Lakeshore transmission line, which was built, I think, 15% under budget and 18 months ahead of schedule. So when I hear comments about, the First Nations are slowing things down, I'd submit to you that when you partner with us and you do so at the front end of projects, in the spirit of free, prior, and informed consent, you'll find us very willing partners who are practical and who like to get to solutions that satisfy everybody. And I'd like to say that what is good for First Nations, frankly, is good for all Canadians. And given that Indigenous equity is now a federal priority, I think it just hastens the speed at which we can operate under the new constructs.
And now you have CIBC on board with you. How is that unfolding? And are other banks showing interest in this?
The CIBC has been a terrific partner for Longhouse. It's a big six bank, and getting that kind of seal of approval, if you will, is a manifest improvement about just our own, frankly, against just our own reputation. We went through an extensive due diligence process in order to be placed on their institutional platform, and they have been nothing but outstanding partners for us. Not only are they making introductions, they're helping us raise capital, and frankly, we're incredibly excited at what's already transpired, and we look forward to some announcements in the new year that I think they will be proud of.
All right, are you looking at any private investment, or are you getting private investors on board with this as well?
So the way we operate is we're in the market looking for institutional capital. We're about to close on the first $300 million, which should be done in the first quarter of 26. and that will be for $300 million. And that is institutional capital. So think large insurance companies, et cetera. We combine that with the projects we advise on with what is available from the loan guarantee programs and what we refer to as concessionary capital. So we blend market-based capital with concessionary capital. So you get to a weighted average cost of capital that's substantially lower than if you were trying to just find equity dollars, which typically is much more expensive. And so we are seeing an acceleration of that. Large corporates are keen to do business, and this country will be rebuilt through the participation of First Nations. And so Longhouse provides what we feel is a market-ready solution by blending those private credit and federal tools in a way that advances the country's desire to build infrastructure, which of course is good for all Canadians.
Okay, we're going to have to wrap it up there, Fred, but thank you very much for joining us today.
Thank you.
Fred de Blasio is co-founder and CEO at Longhouse Capital Partners. Well, coming up after the break, we're going to be talking about investing as well, renewable energy, and where to put your money. That's coming up. And of course, we're looking for your calls on the street. First call coming up. You can reach us 1-855-326-6266 and email us firstcall@bellmedia.ca. The sustainability investing space is at the top of mind for our next guest. She says AI isn't just stressing the grid, it's rapidly creating a new class of renewables-linked impact investing winners. Let's get more from Carol Leibel, CEO of Domini Impact Investments. Carol, thank you very much for joining us today.
Thanks for having me today.
So what are some of the renewables that we're looking at? What's being created in your mind, and who are the winners right now?
Yeah, sure. We do see that there's quite a demand for energy related to the AI data center build out. And with the cheap cost of both solar and the onshore utility scale wind, the renewals are really having their moment to shine. We're looking at traditional renewable companies like First Solar. So they are focused on utility scale solar and are really seeing that increase in demand being a tailwind for their company. But one of the things that's also helpful to them is they have a US-based manufacturing plant that aligns that domestic content requirement incentive well for them.
And what other companies are you keeping an eye on right now with this?
Yeah, so one of the things that we like very much about the AI and data center build out is the broadening out that we see in choices. So while the renewables are cheap and a great source of energy and good investments for us, we're also finding these other companies that can benefit. So things like fiber, grid modernization, grid hardening, and storage plays that come in. So, starting off with a company like Corning. So it's a well-known name, been around for 174 years. First started with the light bulb and then cookware and then moving on to Gorilla Glass. But now really focused on, they're building out a plant in Michigan to create solar wafers. So this specialization in glass and optics, really positioning them well. So solar panels have not been built here in the US for more than a decade. Currently China produces the vast majority of those, but moving that now onshore here to the US. At the same time, not just focused on the solar renewables, Corning also with his optics specialty is able to pivot and embrace in a partnership for the data center build out. So they have a partnership with Broadcom to supply some of the key components for the optical solutions that will help to accelerate their the AI data center processing capacity. In addition to that, so like I say, Corning, older, well-known not only in the solar space, but also the data center build out. You can come across a company like Comfort Systems, which is up about 90% over the past year. And most people would have thought of this as kind of a sleepy HVAC company, but is a company providing mechanical, electrical, and plumbing services, really being a major beneficiary of this AI data center boom. Because if you think about a data center with its high density computing power, complex systems needing both power and cooling, they are uniquely positioned to provide those services. When you look at the percentage of the budget of a standard commercial build for the HVAC, it's significantly lower than the overall budget of a build out for a data center that goes to that HVAC energy and cooling. But Comfort has a nice spot in the market because in addition to providing these services that are very much needed in that environment, they also have this very innovative modular design where they're able to make the builds in their factories, install it virtually to a wall, and then just bring the wall and install it as the modular construction. So making the data center build very quick and very efficient. I like to say, sometimes we talk about the AI trade and we get back to the picks and shovels. And I think Sienna is also a good example of that. It's been a very strong holding for us, really benefiting again from its role in supporting AI and data centers with the high-speed optical network. So where earlier I talked about Corning, think about Corning as developing the highway, but think about Sienna as the traffic system that helps manage the traffic there. Really helping to connect those data centers, boost performance, enhance reliability and management of the data. And as you can see here, up about 178% this year. So quite a broad array, not just renewables, but those infrastructure plays that are needed as we move to the AI and data center needs.
Mike just wants to jump in with a question here.
Oh, thanks. Carol, do you have any concerns about IRRs going forward, given the escalated cost of capital, both on the debt side, but also now on the equity side, given what we're seeing in private equity, private credit space?
Well, I think, we've talked about valuations and how they're very high and they're priced for perfection. I think, there will definitely be winners and losers as we go forward. We know anytime we're looking at an innovative, disruptive technology, that can be a risk. People, I think, primarily have been dealing with that through diversification and sort of mission critical functions. So thinking about maybe owning a basket of these stocks and opportunities rather than sort of just riding one horse, but also thinking about how critical is it, and is there any, is there a unique mode or a unique opportunity for the company that will provide stability and help support that valuation.
All right, we have to wrap it up there, but Carol, thank you very much for joining us.
Thank you very much.
That's
Have a great day.
Carol Leibel, a CEO of Domini Impact Investments. And coming up after the break, notable calls. Well, time now for our notable calls. Today's focus is on Snowflake and not the weather. Yeah, Stifel has raised the firm's price, Stifel, on the firm's price target on Snowflake to 280 from 260, and keeping a buy rating on the shares, following what the firm says was a solid third quarter print. While the 2027 fiscal growth expectations were not discussed, given the strong bookings and healthy net revenue retention, Stifel believes Snowflake management should be able to guide product revenue growth in the mid 20% range for 2027. Meanwhile, Snowflake shares have fallen as much as 9% in pre-market trading after the software company issued a forecast for operating margin in the current quarter that fell short of the average analyst estimate. There are a lot of people on Vancouver Island just 3 weeks before Christmas that are very disappointed with the news a pulp mill there will be closing because of tariff pressures. The shutdown of the historic Crofton mill is leading to a loss of about 350 jobs. CTV's Andrew Johnson has more.
Most people in Crofton, BC can't remember a time when there was no mill.
It's been an institution of Crofton since the 50s. It's a very big change.
Very upset. I mean, it supported our family and so many families in this town.
Now, 3 weeks before Christmas, 350 workers have learned they will soon be out of a job and the pulp mill will close for good.
It's a real punch to the gut for our whole community. To lose a good union job like this is tough any time of the year, but to get that news right before Christmas is devastating.
Mill owner Domtar says the mill has been losing millions for years, and U.S. tariffs that have been hammering the softwood lumber industry aren't the issue. Instead, the company is blaming government regulations, saying logging approvals that used to take weeks now take years, and they've actually been forced to source wood fiber from the U.S.
It's cheaper and it's more readily available and dependable in terms of its supply, and so that should give an indication to British Columbians of where we're at.
The official opposition claims the NDP government has been using the Trump trade issues as a scapegoat.
Tariffs aren't the issue. That's all we've been hearing in the House. It's Trump's fault. It's Trump's fault. It's not Trump's fault. It's this government's fault.
Today, the Premier acknowledged forestry is in a tough spot.
The combination of pine beetle, the need to protect old growth, forest fire, and low prices is incredibly challenging.
The Premier says the BC government will try to figure out a way to keep the mill open and salvage those good-paying jobs. But for now, Domtar will turn out the lights December 15th. Andrew Johnson, CTV News, Vancouver.
And when we come back, Mike Vinegar will take your questions on First Call. Time now to get our first calls in and our first emails as well. And this one's from Carl. What is your opinion of Canadian apartments REIT? Do you see more people renting if there's a bigger downturn in the real estate markets?
So full disclosure, we do own Canadian Apartment REIT for clients and for family accounts. We like management very well. We think it's a very well-run REIT. It is the largest publicly traded apartment owner in Canada. I think they own about 50,000 units.
Wow.
They've been going through an, I guess you could say, a high grading type of cycle where they're doing a lot of renovations. They've been selling off a lot of properties where they think there's less upside opportunity and recycling the capital. They've been buying back stock. They did increase the dividend, I believe, last year. We wouldn't be surprised to see another unit increase. As far as more people renting, that's definitely probably part of the playbook because real estate prices are still very high in this country, especially for the younger generation. And a lot of younger generation are probably thinking, you know what, I'm not going to be able to afford to buy, so I will have to rent. Yeah. And they provide a suitable product for those people.
And it's a tough choice for some of those people because they're also looking at crunching the numbers and go, maybe it is just cheaper. Or maybe the return on investment is better to rent if you can find a good place.
Absolutely. There's a gentleman who wrote a book in 2017, I believe it was, and he crunched a lot of numbers to say that owning property isn't necessarily better in the long run.
Yeah.
there is an argument to be made that renting and investing the difference into the market and a varied asset class is actually better, but it is a qualitative trade-off.
And discipline as well.
Absolutely.
Hey, I got all this extra money.
Yeah.
Okay, let's get another email in from Colin, Jackson Financial. Can I please get Mike's thoughts on that?
So full disclosure, we do own Jackson Financial. We like it quite a bit. Jackson was spun off a few years ago from Prudential PLC, not Prudential in the U.S., but it is a U.S.-based life co, although what they're most known for is their retirement product, specifically what's called an RILA, which is a mouthful to say an index-linked annuity.
Yeah.
And so they're very big in that space. We really like the management team. They've got a huge amount of capital. They're what's called RBC, regulatory-based capital, as of the last quarter was something like 580%. The company's own target is to have 425%, which in and of itself is already quite a high number.
Yeah.
They've got a great dividend. They've been buying back stock. Since they got spun out from Prudential, I believe they've bought back 33% of all the shares, and they've got $1 billion authorized buyback. I don't know how much they've bought back on that billion, but it's going to give them a lot of room to buy back.
Okay. On that note, Mike, we're going to wrap it up there. Thank you, as always, for joining us. Mike Vineker is Portfolio Manager and Senior Wealth Advisor at Propellus Wealth Partners, IA Private Wealth. He joined us today. Andy Bell's up next with the Open. The markets will open in a little over 30 minutes. Have a great day.